Howdy, Jacob here. Today we're going to do a deeper dive on Ulta Beauty, company 128 of our fundamental screener. It got within 10% of a buy price, and so I have done more research by looking through the company's last few quarterly reports as well as their most recent 10K. I pulled some notes from them, and then I also redid my assumption setting. But before I go into the notes, I want to remind everyone, just go over the financials quick and then restate that everything I say will be of my opinion. Please do what you want with it. Don't take it as, end all be all. This is just my perspective. This is the goal of this video is just kind of show you the things that I look at in a quarterly report or 10K, and hopefully you can do your own research, do your own due diligence, come up with a figure that makes sense to you, and then stick with that. But to remind ourselves about the business, they're in the specialty retail industry, 19.2 billion market cap on 18.4 billion enterprise value. Incorporated in 1990, company has very extensive growth from 3.2 billion in revenue in 2015 to 11.2 billion in 2024, with growing operating and gross margin and ROIC, with a balance sheet that shows no short-term debt, no long-term debt. Really only interest-bearing debt is their 1.6 billion of capital leases. And their cash flow statement has increased capital expenditures, so they are reinvesting back themselves a little bit, but much higher cash from operations, with use of cash almost entirely being their share repurchases. So let's go to some of the notes that I wrote down after reviewing the company a little bit. So the first thing I note is that their CEO is pretty vague, and his language is very consistent in the quarterly reports. It sounds like he cares most about sales, gross profit, diluted earnings per share, and then their loyalty program improvement. So their loyalty program was released recently, so that's one of the figures that he's looking at. And then also it sounds like he's really caring about sales growth, gross profit, and diluted earnings per share. Their 2024 outlook assumes 4 to 5 or projects 4 to 5% increase in comparable sales. They plan on adding 60 to 65 new stores, representing roughly a 4.5 increase in number of stores, and slightly lower than fiscal year 2023 operating margin, low 14% compared to the 15% in 2023. They will expand internationally. So currently they just have stores around the United States, all 50 states, and they are looking to expand to Mexico by 2025. So that should help with the number of stores increase. That's one of the good and bad things about retail. One of the good things is that you can kind of expand internationally, or really just expand globally by just putting down more stores. But there's a big if of you don't know if it's going to work the same, So I read something about, or I listened to, Warren Buffett and Mohnish Pabrai talk about See's Candy and the fact that in California it's worked fantastic, but outside of that, when they've tried to expand to other regions, it didn't kind of grasp and hit the ground running with as much, return on invested capital as what their California based is. So in California, they could increase the prices 10% on their chocolate their butter nickel or whatever, their candy, when inflation was 3% and maybe there was really no dampening to sales at all. Whereas if they were to do that elsewhere, it just didn't hit the ground running as much. So it's nice that they can expand their stores and increase, sales that way. But also keep in mind that this could just be a big investment into a place that doesn't necessarily work out. So it could be a poor investment possibly, but just something to keep in mind. Ulta has about 9% market share of their beauty product industry, their top competitors being Sephora, and then the well-known Nordstrom, JCPenney's, Macy's, CVS, Walgreens. That is not what they primarily do, but they do have those beauty sections within their store. Last 3 years, they had net store increase of 3.5, 3.6, and 2.2% respectively. They're just an interesting stat: 76% of loyalty members transacted solely in the store, 18% from both, which leaves just 6% getting all of their sales online. So the thing about makeup and some of these other beauty products that they sell, it's very common for them to go into the store. So really an increase of store count should really improve their, it's not like it's not like other stores where you just, everything's done online. This shows you that of their loyalty members, and again, it's kind of specific to their loyalty members, but it should roughly equate to the general population, where majority are actually getting sold in the store. Few are actually solely online, some a mix. And my wife has gone to Ulta before and definitely goes in store due to their wide variety of complexion makeup supplies and such. Whereas online, you see it on a screen, it's not going to be that color when it comes in. So you can actually physically see, the coloring of complexion that you get. So that's something I found interesting. So them increasing number of stores should actually very well in line increase their sales. They've partnered with Target for Ulta at Target, currently 500 in Target locations with the goal of up to 800 in time. Their allocation of 23 sales was 41% cosmetics, 19% skincare, 19% hair products, 15% fragrance, 3% services, 3% others, with their top 10 brands making up about 55% of sales. And their comparable sales growth for the last 3 years were 38%, 16%, and 6% respectively. So we are seeing a decline in their comparable sales growth. But again, it just kind of makes sense. The bigger you are, the less capability you have to grow. And I mean, we're in a time right now maybe where people are caring less about makeup and such, and maybe they focused more on that earlier. But I think it's going to be one of those things where it's not going to go away. I don't think there's ever going to be a time where people don't care about their beauty products. And I do think Ulta has a good market share of it. And I do think they have the capability of growing, especially with increased number of stores and people really caring about physically seeing themselves in the store to make sure that their product is correct to them. Lots of reinvestment with year-over-year growth from 2022 to 2024 of 81% and 39%. And then their free cash flow of the last 3 years actually was 110%, or their share repurchases amount from their free cash flow is 110%. So they actually spent more repurchasing shares than the money they actually received from free cash flow. So they had to dip into their cash because they didn't issue debt for it, since they don't have any short-term or long-term debt. But they did take from their cash supplies there. And when I do look at their share repurchase, this is kind of similar to a Google, where they're kind of just buying a lot of shares at all times. Their use of reinvestment is really increasing number of stores, which they are doing. Like I said, they're going to issue about 60 new stores over the next couple years, whoever that said that. I don't remember what that was. So they will increase their number of stores about 60 to 65 right here, which is a 4.5% increase. But the rest of their cash is just going towards share repurchases. We see 1,300 shares at that price, 746, 1.9 million. So this is definitely the time where they dug into their cash reserve, bought back a lot at 395. We'll see once I put in my new assumptions whether I think that was a great price to buy or not. So really the only thing I did here was I increased the margins, the difference in margin a little bit. I increased their share repurchases due to the fact that 3% would be about 600 million. And I think that they can do more than that to offset their stock-based compensation. You're looking at about 650 million. 3.5 would be about 750 million. So I am still leaving about 10 to 20%, 15 to 20% of their free cash flow to reinvest, to make acquisitions that make sense. They do it if they want to, but that's my assumption here. I actually did increase that, and I think I'm sticking with the 18p in price free cash flow. And we get to a price that now needs to fall 15%. I mean, this is actually a fantastic company that I do think we're not too far off until I start, putting buy orders in for. I think the research I've done on it shows me that it is a fantastic company. My logic for 7% is like, if they increase their due to inflation increase at 3% and then increase number of stores 4% a year, you're really looking at a 7% revenue increase. And I do think these margins are very much possible. They've done in the past. I do think that there's a chance they could be lower due to going into unknown international territory, but I feel pretty good about this, and I do hope you enjoy the video and have a great rest of your day. Thank you.